Okay, here we are. We're going to do sales entries and purchases together. We're going to do average inventory together. Then I'm going to do the retail method, and then we'll look at the other two, reconciliation and petty cash. So you're going to have about 6 videos here. That's just so that if you only need to look at one, you don't have to look at the whole thing. So now change numbers. It's a very same exercise you have in the test, except for the numbers are different. So very quickly, we have bought, or we've sold, I'm sorry, $3,000 worth of inventory. And that $3,000 worth of inventory cost us $1,500. First thing, we record the sales and we record the accounts receivable. We're using the perpetual inventory, so we have to record the cost of goods sold. So we take it out of inventory and we create the cost of goods sold entry. Now we add the delivery expense, and we're going to actually charge the company for that. So we pay cash and we add it into their accounts receivable at $50. Then they return sales or they return merchandise of $500 before there's anything taken out. So now I have to take that out of accounts receivable and add, put that into the sales return. So then we also have to put that amount of inventory back in. And that inventory cost us $250. So we put it back into the inventory and we remove it from the cost of goods sold. Now they pay the invoice, and what they pay the invoice and do not pay for the freight in this situation. So how much do they owe us? We're just considering the merchandise here. They bought 3,000. They returned 500, which means the AR for the merchandise is sitting at 2,500. They get a 2% discount on that, which is $50. So this is what they bought. This is what's in accounts receivable. So you've got some numbers already here. You know that you're going to remove 2,500 out of accounts receivable. You know the discount is $50. That means they're going to pay $2,450 in cash, which is the $2,500 minus the 50, which gives you $2,450. Okay, so that's the sales side. Now, the other side, the purchase side, is pretty much the same, only they're not dealing with cost of goods sold now. What they're doing is they're recording the merchandise. They have recorded the delivery expense. Which we're going to disregard when we do the discount. And they've recorded the return. They returned $500 worth of merchandise. So they take that out of their accounts payable and take it out of their inventory. And now they're going to pay the merchandise bill, okay? And they bought 3,000. They returned 500. They owe in AP $2,500. They get a 2% discount, so their discount is $50. That's kind of the reverse. First of all, we know how much we're taking out of accounts payable with a debit. We know what the discount, that $50 here, that's a discount. That's the discount. We take that directly out of the merchandise, and that's $50. And that leaves, to balance it out, we're going to pay $2,450 in cash. So they owed $2,500. They get a discount of $50. and they pay cash of $24.50. Does that make sense? Now, try to apply that to the test and see what you come up with.